Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I want to go over a couple of things. I was looking at some articles. Let's start with the Consumer Price Index in June 2021. The numbers they released, all items CPI 5.4%. Let's get real, it's probably higher than that. It's probably more like 10% or something like that, or even greater than that. Food came in at 2.4%, energy a whopping 24.5% year over year. And all items less food and energy, 4.5% is what they are posting. Now, I do think that these numbers may calm down a little. I mean, we had hardly any activity back in 2020 for in terms of the level of where price inflation is. So obviously, we're going to post some pretty high numbers here, irrespective of what they actually are. I mean, I do think these numbers are all made up. I don't even know why we use them, but that their numbers are even going up. So that's a good thing for our investments. I know our investments are kind of going sideways at the moment. I do think that it's going to get priced in, and it could happen pretty quick. We could see these things turn and move on higher. Now, everyone in the investment community, they do think it's transitory, and there is a transitory nature because we shut down the economy for a couple months during COVID, which was a year ago. And now things, they are coming back. So that is transitory in nature. So your percent year over year is going to be pretty large for inflation. So I do think going forward, we would see a reduction in the rate of inflation makes sense. I don't think we're going to post 5% month, year over year every single month. But we could. We don't know. It'd be interesting to see what happens going forward. Now, if we're in this inflationary period, which I think we are, because of the expansion phase of real estate. So if we're at the beginning of an expansion phase of real estate, we're going to get more inflation as time progresses. And it depends on how efficient they are at building the new homes. If they're more efficient at building new homes, more inflation. And if you look kind of back, and I was looking at this thing, it says investment firms like, BlackRock, they're buying houses and they're getting into the real estate market much more so than they did before. Why are they doing that? You could say that, in a bubble, if you look at the big bubble diagram, the beginning is the smart money, the middle is the institutional phases, and at the end is retail. And I think that we're probably in the middle of the institutional phase where it's still very early in this game. The big gains haven't come yet in real estate. And they're the ones loading up, buying homes before those big gains materialize. We are still short, 3 to 4 million homes is what I've read, 3.5 million, 3.8 million, somewhere in that range. And those homes have to be built. So that's the conundrum that we're in. And I think we're going to see much higher prices than where we are today. Back in the previous, we'll call it crash, where they created a bunch of money in 2008, 2009, that crash. The reason we didn't get the inflation is because we weren't in an inflationary time frame. We weren't in the economic cycle. We weren't in the, quote, real estate cycle. That's what leads it. Now that we're in the real estate cycle in an expansion phase, the inflation's going to come. The money printing that they're doing is going to get released, quote, into the wild. And when that money gets released into the wild, and our cheetahs start taking off in commodities, what they're going to try to do, and you can see it right now, they're going to try to direct the money that they're creating into investments that they want to benefit. So they're trying to guide it into bonds and stocks. But what's going to really happen is when the inflation kicks up, which is happening, we can see it, is that money's going to go to the undervalued sectors. It's going to go to commodities, it's going to go to precious metals, it's going to go to real estate. And you can see some of it going to real estate right here with BlackRock. That money, they're going to try to funnel it away, but it's going to naturally want to go to those sectors. So they've created this flood of money, just flooding it all in there. They're hoping it goes to the areas that they want it to. It won't. It's going to go to the undervalued sectors because in 08, 09, the undervalued sectors were stocks. Now, it is now commodities, real estate, and precious metals, and that money is going to find its way. It's going to slosh around and get to those sectors eventually. It just takes a little bit of inflation continuing to happen year over year, and people are going to find out it's not going to be transitory. That the inflation's here, it's here to stay, and it could be here for another 5 to 15 years, depending on how long the real estate market lasts, the deficits, and the expansion phase. So once people find that out, I think it's going to be higher for the stuff that we're in. Now, I was looking at another article. It says Wells Fargo tells customers it's shuttering all personal lines of credit. The bank is shutting down all existing personal lines of credit in coming weeks and no longer offers the product. Looks like we've got revolving credit lines. You can borrow up to $3,000 to $100,000. Way to consolidate higher interest credit card debt, pay for home renovations, or avoid overdraft fees on linked checking accounts. So that they're shutting it down. There's been two camps here. At least that's how I see it. It doesn't mean you've got the camp where they have problems. They're shutting it down. That's their riskiest form of credit. And that we're going into this, we have a problem phase. Or you can look at it from the other perspective that we have very high inflation coming. They're shutting down an avenue where people have access to credit lines, where if we have really high rates of inflation, if you want to borrow as much as you possibly could, buy hard assets, and then pay it back with worthless dollars, that's another thing that they could be doing. I don't know the actual cause. I don't know why they're doing it. Obviously, I don't think other people necessarily know why Wells Fargo's doing it, behind doors, knowing, not speculating. So I think it could be either camp. Either they're in trouble or they know that massive inflation is coming and they want to shut down where people have easy access to credit, where they would just max it out and pay it back with worthless dollars. Because Wells Fargo is a bank that is part of the Federal Reserve, and they know what's going on from an inside viewpoint. So those are the two kind of outcomes there. So I think what's going to happen is we're going to have high rates of inflation. They flood the entire system. They're trying to debase the currency in the process, which means that the dollar is going to go down in value. It's going to flow into the stuff that we're in commodities because it's the undervalued sector, and that's where people are naturally going to flow money and precious metals. And it's just going to take some time for everybody to get scared into those positions, so to speak. And money's going to rotate out of stocks and bonds and into the sectors we're in, causing even a larger flood. So it's going to be a pretty interesting time. Again, timing-wise, not really sure. The way I'm doing it, identify the undervalued companies, put some money into those undervalued companies, and just sit in them. That's what I'm doing. I'm protecting my wealth, and I'm going to go into what I think are good inflation hedges to hedge against this inflation that I think is coming. If you guys like this content, give me a thumbs up. Thanks for listening. This is Finding Value.